All right, today we are going to tear apart a really fascinating DeFi strategy. Now, on the surface, it just looks like a couple of crypto loans, but when you look under the hood, it's this really clever play on yield, on risk, and, well, it's a big bet on where the market's heading. Okay, let's dig into it.
So this is where it all starts. We're looking at two screenshots from the Jupiter lending platform. Over on the left, you've got a position that involves Solana, or SOL. And on the right, there's one using a version of Bitcoin called CBBTC. Now, these two aren't separate things. They're actually part of one big strategy, and our job is to figure out exactly how it all works.
So, before we can see how this all clicks together, we've got to break down the moving parts, right? Let's get into the fundamentals of these two loans.
All right, first things first. Collateral. It's the bedrock of any loan, right? In this case, the user has put up their own crypto. We're talking over 141 SOL and about 1/10 of a Bitcoin as security for the money they're borrowing.
And then there's APY, annual percentage yield. Now this is where the magic happens. See, this number isn't just the interest rate you pay on the money you borrow. In DeFi, it can also be the yield you earn on the collateral you put up. And that gap, the one between what you earn and what you pay, well, that's the secret sauce.
And boom, right here, you see the huge difference. The SOL position is raking in a pretty sweet 6% APY on its collateral, but the Bitcoin position, it's earning zero. Zilch. Meanwhile, both have borrowed USDC stablecoins and are paying 3.7% interest. So you can already start to see where the profit engine might be firing up, can't you?
Which leads us to the big question, the one everyone wants to know. Is this thing actually making any money? Let's move on and actually crunch the numbers to see how it all adds up.
So you've got one position earning a nice yield, another one that's just sitting there, and both are paying out interest on the debt. So when the dust settles, is this thing actually in the green or in the red? And for the SOL position, it's a big yes. That sweet 6% yield it's earning on the Solana collateral just crushes the 3.7% interest it owes on the USDC loan. The result? A net gain of over $53 every single month.
But the Bitcoin side of things? Yeah, that's a whole other story. Since its collateral is earning 0%, there's nothing to cancel out the interest it owes on the loan. The source material calls this a net bleed, basically a slow leak of just under $9 a month.
And this chart just lays it all out perfectly. Look, you've got about $62 coming in from that SOL yield. Then you take away the $18 you're paying in interest across both loans. See how that works? The profit from the SOL side more than wipes out the loss from the Bitcoin side. And the bottom line, when you add it all up, this whole setup is spitting out about $45 a month in positive cash flow. Now look, it's not going to buy you a new car, but it's a steady, consistent gain. But wait a minute. A small monthly profit is great, but it means absolutely nothing if you're sitting on a time bomb of risk. So now we have to talk about the dark side of all this, the ever-present danger of liquidation.
I mean, earning a passive $45 a month sounds awesome, right? But with this kind of stuff in DeFi, there is always a catch. So what's the hidden danger here? What could just vaporize not only your profits, but your entire investment?
That risk, in one word, is liquidation. If the market value of your collateral, your SOL or your Bitcoin, crashes below a certain point, the system just automatically sells it off to pay back your loan. You don't just lose your assets, you usually get hit with a penalty on top. It is the #1 thing you want to avoid. So how do you measure this risk? Well, you look at something called position health, which is basically just a safety buffer. For the SOL position, that buffer is massive. Like, the price would have to crash 70% to be in trouble. But the Bitcoin position? Yeah, it's walking a bit of a tightrope here, with a much smaller buffer of just over 56%.
So what this tells us is that the strategy is really a mix of two different risk levels. The SOL loan is playing it super safe, very well cushioned against a market drop. But that Bitcoin loan, it's way more aggressive, and it means you'd have to watch it a lot more closely if the market gets choppy.
Okay, so right about now, you're probably thinking, wait, all this risk, all this management, for $45 a month? And you know what? You'd be totally right to think that, because that monthly yield, it's not the real point of the strategy at all. It's just a nice little bonus.
No, the real game here is a long-term one. This person isn't trying to make a living off of $45 a month. They're using that tiny bit of yield to get paid while they wait for something much, much bigger to happen, a full-blown market recovery. And this table is everything. It puts the whole strategy into perspective. Look at Bitcoin. It needs a 74% jump to get back to its all-time high. Solid. But Solana? Whoa. It needs to climb a staggering 233% from where it is right now. Just
Let that sink in for a second. 233%. That means the value of their SOL collateral would more than triple if the market just gets back to where it was. That is the jackpot this whole strategy is aiming for.
So what's the impact of all this? Well, first, the potential upside on that SOL is just massive. Second, as SOL's price goes to the moon, that little $3,000 loan, it becomes peanuts in comparison. Super easy to pay back. And third, and this is the beautiful part, while you're waiting for all this to happen, you're just sitting back collecting that sweet 6% yield.
All right, let's tie this all together. What have we seen? We've got a small, steady profit coming in each month. We've got a risk that's being carefully managed, and we've got this massive potential payoff waiting down the road.
You know, there's a quote from the source that just nails it. It says, "You are effectively being paid to wait for this recovery." And that's it right there. The monthly profit isn't the goal. It's the fuel that lets you play the waiting game. It's a genius way to set things up so you literally get paid to stick to your guns and wait for your big bet to come true.
So what you have is this really fascinating mix of short-term income and long-term speculation. It really makes you think, right? This whole idea of combining patience, yield, and leverage, getting paid to hold an asset that you're bullish on anyway. Could this be a peek at what smarter investing looks like in the future? Something to chew on. Thanks for digging into this with us.